if I had to put a percentage on it, probably about 85% of our uh, younger generation thinks this way. You can't shop for a home without knowing how much you're approved for.
Hello, everybody. Welcome to YBI, where we talk about financial ways and opinions and strategies for you to grow yourself and your finances. Today, we have an exciting episode for you. We have another interview up for you. My brother Zion, you want to introduce this man?
Absolutely, man. Super excited to have this brother on here today with us. He is a personal friend of mine. My guy that's gonna help me get a loan for one of these houses. We met a little while ago, and he has been phenomenal through this entire process. So we wanted to bring him on. His name is Keith Perry. He is a mortgage banker. So welcome to the show, Keith. We appreciate you coming on. How you doing, man?
Man, what's up, fellas? I'm good, man. Glad you brought me here. Excited, man. Trying to, ready for what questions you guys got, and I'm trying to do my best, man, to answer them for you.
Oh, yes, sir. Yes, sir. This is going to be good. It's going to be good, man. No pressure at all. Everybody wants your financial advice, but no pressure. It's going to be fine.
All right.
So just tell us a little bit about yourself, man. How long have you been a mortgage banker?
Yep. So, I'm assuming the audience is Illinois based. So I was born in born and raised in Maywood, Illinois, which is a western suburb of Chicago. But, and this is about me, I'm sorry. But I graduated from Northern Illinois, where I played collegiate football there. After I got out of college, I dwindled into a couple fields, which didn't work out for me. And my family brought me into the mortgage industry. Knew nothing about it, been here for 15 years. So the mortgage industry has done well for me. But overall, it's brought, I guess the intrigue of learning about each step and aspect of the mortgage industry, of real estate, period, is what kept me here for this long. So yeah, that's just a little quick summary about myself.
Cool. So what exactly is a mortgage banker for those that don't know?
Yeah, good question, because I get that a lot, actually. A mortgage banker really is just a fancy term for like a loan officer. But some people are like, okay, what's a loan officer? We are really just, the technical term are people who originate loans for consumers. So originate, obviously, you started from the beginning and you create a loan package for a client so that they can, finance the home. But really, I just call myself a mortgage guy. So I'm just the guy that help you get financing for your home.
I think you already answered kind of what makes you get started, but what are some major misconceptions surrounding purchasing a home, be it your first or even having multiple properties?
Oh, man, there's so many out there, man. I guess on the negative side of things, a lot of people think that when you buy a home, and again, I'm speaking in the terms of a first-time home buyer, meaning you're gonna, own a home, not in the terms of buying a home and rental purposes and things like that. But typical first-time home buyers think that you need 20% down payment to actually get a loan. So if we just use normal numbers and say you want to buy a home for $100,000, a lot of people think that you need $20,000, in the bank to buy a home, which is absolutely not the case. We've got loan programs that are from as low as 3% all the way up until 20%. But there are programs out there that fit every need of the client. So that's one of the biggest misconceptions. Another one is the credit score. A lot of people feel like you need a 700 credit score to get to get financing for a home. Now, I will prefer a 700 credit score because the higher your credit score, the lower your interest rate, the easier your approval will be, and things like that. But a 700 is not a requirement. Since this pandemic started, a lot of different banks and lenders have went to making their guidelines a little more strict in regards to the requirements to get an approval for a loan. But let's just speak in general terms because, I don't want to get too specific in each what each bank is doing and things like that. But a 620 is typically the baseline to get financing for a home. So will it be a little more difficult? Yes, but it is possible with a 620. Another one I would say, a lot of people do is like, should I find my home first before I, talk to a mortgage banker? And that's absolutely the wrong approach to have, And unfortunately, it's probably about, if I had to put a percentage on it, probably about 85% of our younger generation thinks this way. You can't shop for a home without knowing how much you're approved for. So, well, you can, but it's the wrong thing to do, because why even get yourself in a situation where you may put an offer on a house, get under contract, and then we come back and tell you you're not approved for that home. The first step should be get pre-approved for a home. That way, you know how much you're approved for, and you can shop, correctly. You're not just out there and I hate to use this term, but wasting each other's time as far as the realtor and yourself. So yes, get pre-approved before and we'll talk about the pre-approval process, as I'm hoping you guys ask that, but if not, I'll go into that. But the pre-approval process later. But yes, get pre-approved first. On the flip side of all these misconceptions, some things that people also think is that, all I need is a down payment money. If I tell you like, hey, we got a program that's 3% down, that's all, it's only going to take 3% to get this loan. So going back to our, just say 3% is $5,000. Somebody may say, well, I got $5,000 in the bank, let's do it. But it's not just about the down payment. There are costs that comes with buying a home. You have to pay from the inspection, the appraisal, title company, the bank, attorneys. There's a lot of fees that come with buying a home. So you have to be prepared in that aspect on knowing what exactly comes with that. It's not all about, oh, they can do 1%, I got 1%, or it's only 3%, well, I got 3%. You have to convince a bank that you are prepared to take ownership, and you have to convince us in so many words that you are credit worthy of having hundreds of thousands of dollars given to you. And if your down payment is $3,000 and you have a bank statement of $4,000, it may be a little weary for an underwriter to approve that, because they don't want to set you up for failure. So those are some misconceptions that we deal with on a daily basis, that we're either explaining in a good way, or in that terms, explaining in a way that it's not as sweet, or as some people may think.
Mm-hmm. Yeah. So if you guys haven't gone back to watch the video that we just did before this one, it talks about all of the costs that are associated with purchasing a house. There are so many. So we're super glad that Keith went into that, because it's not just us that's just telling you guys, oh yeah, no, he's a professional. There are other costs that are associated with this. So make sure that you're in the financial position to dive into that, because it's not just, oh yeah, let me just put $3,000 down. Nah, it's, like you need to have at least double that, just to make sure that you're good, like regardless. Like you don't want to dive into, having hundreds of thousands of dollars, but you only have $14 left in the bank after you done paid for everything for the house. Like you don't want to live check to check. So like we said, live under your means, and don't buy a house that's at the top of the loan range if you can't really afford it. So find something that's modest, but something that's going to make you comfortable, and get your feet wet in terms of that first property.
And save up, you should already pretty much have saved up 6 to 9 months of your expenses. We've been preaching that a lot here on this channel. So if you already have 6 to 9 months of your expenses, you even can roll that into maybe like a repair or a remodel, whatever you kind of need to get going. Or if the roof does cave in or you lose your job, you already have 6 to 9 months worth of your expenses saved up. And if you're already planning to buy a home, you can like, well, by my pre-approval, I know my mortgage payment's gonna be about this, taxes. You can calculate all those things and start saving for it before you even walk into the office.
Mm-hmm. So I guess that's a good segue into the pre-approval process. So what does that really look like for you, and what is it that you need from us? Like if I was to say, you know what, I want to purchase a home right now today, what is it that you need from me as a consumer?
Gotcha. So the pre-approval process, obviously this varies from bank to bank or lender to lender, but it's pretty much saying that, hey, based off the information you gave us, you will be approved if the following circumstances remain the same once you find a home. So what that entails is that up front, we ask you to complete an application. Everybody is going to have you complete an application. And it's just getting the bare minimums from you. Say, hey, where do you work? How much do you make? How much you got in the bank? Can I pull your credit? Those are, that's the basics of the application. And then once that application is completed, myself would review it and determine how we're looking so far. You know, that point, say, okay, this guy's credit, he's got a 680. You know, he makes good income. He's got 5 months saved up in the bank. He's so far on pace to get this pre-approval. The next step is what differentiates us from other banks is that we take it a step further with the pre-approval because we want to make your pre-approval really an approval for a mortgage. So we start collecting documents from you guys. Your 2 most recent pay stubs, your 2 most recent W-2s, your 2 most recent tax returns, and your 2 most recent bank statements. Everything is set in 2s because we want to make sure that we see consistency in the documentation. So we ask for a lot of that up front before you even have a home, before you even start shopping for a home. And a lot of clients say, why do you need so much? It's because this pre-approval is not just a letter saying, hey, you know, this is like you get in the mail from a credit card company or something like that. Mm-hmm. This is pretty much saying, after I review these documents, you are going to, your pre-approval is going to turn into an approval for financing. So, so to answer your question, Zion, yeah, we ask for pay stubs, W-2s, tax returns, bank statements. And again, these documents are going to the underwriter when it's time to purchase, when you go into contract on a home. So we already know, meaning myself and yourself, that we've already looked at these numbers. Everything looks good. The house fits the description of what we described in our numbers. We're going to be good on our approval.
What is the difference in FHA versus conventional loans? And are those the 2 only loans that people can get for home?
Gotcha. Those FHA and conventional, those are the 2 names that we always see, always hear about. And they are the 2 most popular loan programs out there. FHA is a government-based loan, meaning the U.S. government created this loan for clients that typically conventional clients won't accept. I'll go into conventional in a second, but so what I mean by that is FHA, the Federal Housing Authority, said that, you know, some conventional loans may not like a 620. We will take a 620. Some conventional loans may not like you having only 2 months worth of savings in the bank, which we call reserves. We will take 2 months worth of savings in the bank. So FHA is more buyer friendly. In regards to the actual property itself, FHA does more of a detailed look when they come out and do the appraisal. They want to make sure the house, not only is the value there, is the safety of the home is there as well. Now, conventional loans, these are loans that are set up by private banks and lenders, meaning your Chases, your Guarantee Rates, or whoever. They have guidelines for those because they pretty much can create their own, but we still all follow a backed standard when it comes to this from Fannie Mae and Freddie Mac. But I don't want to get too in depth in that because it'll start, you know, confusing a lot of people. But
right.
Conventional is pretty much insured by private banks versus FHA as the government. There's no gray area when it comes to FHA, but conventional is all based on the actual bank to determine if they're okay with this or not okay with that, such and such. But FHA in general is more buyer friendly in the aspect of, you know, you're not that perfect client. You know, There's still people, you know, they do 3.5%. Some conventional loans do 3%, but a lot of people may not qualify for the 3% because they may make too much money. So it's a lot of different avenues that those 2 programs can, you know, that they relate and that they're different in. But when we speak with clients, we pretty much listen to what they're trying to do, their situation, and we can determine what's the best program for them. You also asked, is there any other different loans out there? There are. There are VA loans out there, which is another government loan, but it's specifically for veterans. There are USDA loans out there, which is for people buying in, what do you call it, like rural areas, not up, the areas aren't as upcoming yet. So, but for the most part, FHA and conventional are the main programs. There are tons of different, are the main products. There are tons of different programs inside of both of those. So, so yeah, that's the main difference between the two, and a couple extra programs after that.
Okay, that's what's up. So we've been talking about, we've had people that come to us and say, hey, my credit score is not where it needs to be. And if you guys haven't watched our episode on credit, go back and do this. But in terms of purchasing a home, is there anything that you guys as a company do to gauge where people are at and what it is that they need to do to improve their credit to purchase a home?
Yeah, good question. Because as a mortgage banker or loan officer, we're technically not required to improve people's credit. We don't know your life situation as in detail as you do. But what I do, and I'm gonna speak on my own terms, is that when I do have a client that's not technically prepared or ready to actually buy a home, I do look at the credit. I do look at what, we have resources that can tell us that, hey, this current client is a 640, what do you want the credit score to be? And it's all technology. I put it in the system, say, I want this credit score to be a 680. Then, the system runs in and say, okay, for this client to be a 680, he needs to, take care of A, B, C. So that's the conversation I began to start to have with the client. So, so yes, I have the resource of the software to actually kind of, in so many words, be a credit repair guy. But I also, just off knowledge and experience, I give that education to clients too. You got to clean up the past. Any collections, any charge-offs, any judgments that's on your credit, that has to get taken care of ASAP. Because no matter what you do to continue to strengthen the credit, those derogatory items are going to continue to pull that credit down. So that's your first step, is we got to clean up the past. Whatever is out there, we got to, just got to get it handled. Make your payments on time. I know it sounds cliche-ish, but that's what you have to do. The credit bureaus are looking to see how responsible you have been with your credit. Pay your credit card balances on time. One other thing that's probably one of the biggest misconceptions, but in regards to credit, is that revolving credit has a huge impact on you. And revolving is like credit cards. So let's just for a quick second talk about the difference from revolving credit versus installment credit. When you buy a home or when you buy a car, you get a loan for X amount of dollars, and you have a payment set at this payment for X amount of years. That's an installment payment. Same as student loans. These are installment payments. You're going to pay this every month. Revolving credit is a credit that changes per month. You control it. Your credit card limit is $5,000. 1 month it can be $2,000 balance. Next month it can be $50 balance. The next month can be $5,000 balance. Credit bureaus love to see clients work revolving credit, because that's showing that you are, you are responsible with handling different balances of money. Always use your credit cards, pay them down. Typically, and it's an unspoken rule that you shouldn't carry more than 30% of the actual limit. So again, using smaller numbers, if your limit is only $1,000 for that credit card, at the end of the month, you shouldn't have more than $300 balance on it. If you can, you pay more. Don't settle for just what, the bare minimums. Just like we talked about the credit score. 620 may be the score, but don't settle for a 620, because there's more to offer you if you just do a little more. So yeah, those are the things that, I talk to clients about when it comes to credit. And I know a lot of it is just what I said is general, but it plays a huge factor into your score jumping from what we see today to what we could possibly see in 30 days.
Absolutely. So again, if you have not watched the video on credit, do that, because it'll help you tremendously. And exactly what Keith is saying, that's what we said. So go ahead and go take a look at that, because it's good information, and to make sure that you're going to be set up to make his job that much easier, because you want to go into the process and not get denied. You know, like there's nothing worse than, hey, I want this house. I know exactly what I want. I can afford it. I can do this. I can do that. And then you get denied because your credit score is not right. So get yourself together, make sure you're prepared, save the money. Everything that we've been saying will make his job that much easier and get you the pre-approval that you need. So what advice would you give your younger self in regards to financial intelligence and owning property?
Oh man, my younger self.
Yeah, so like 2 days ago.
2 days ago.
Man, my younger self, man, that guy was, you know, he was different. But I guess I would just tell him that, you know, you have to start thinking past today. Start saving right away. It's, again, very cliche-ish, but if you can save even $100 a month, you're doing better than what you were doing prior to saving that $100 a month. It is so crucial that you put, that you have assets, that you have the credit. Those two will get you where you need to be in the financial world. You just have to be prepared in those two aspects. So that's probably the main thing I would tell my younger self, is that save and stay on top of this credit.
Absolutely. Save that money. That's what we've been preaching to
Save that
everybody.
money, man.
Yes, sir. So for the simple fact that we have a limited amount of time on Zoom, we have to actually cut it here. But again, Keith, thank you so much for being here, man. We're going to add all your social media handles and all of that stuff. If you want to get in touch with Keith, you can absolutely do that. We'll link the application, everything below. Thank you so much for being here, for sharing your knowledge with our viewers and with our audience, man. We really, really do appreciate it. We can't say that enough. Roman, anything?
Thank you, my brother. Please, everyone that like this, go ahead and like, share, and subscribe to our channel so you can get more of this juicy information we got for you.
Definitely. Appreciate y'all, man.
Thank you, sir. We appreciate it. As always, you guys know that we may be young and we may even be broke, but we are always investing. Remember that. Thank you guys so much. Thank you, Keith. We will talk to you guys next time. Peace.
Hey everybody, thank you for listening to Young Broke and Investing. We just want to let you know that these are the opinions of the hosts. They're not meant to be the basis of any security purchases or investments. We're trying to give a little information out there for everybody, and have fun and be safe.